Welcome to Talk Tickers.
Glad to be here.
Today, we're diving straight into the first quarter 2025 earnings call for ARES Management Corporation.
Right.
Our mission, as always, is to really unpack the crucial financial results, the strategic updates you need to know.
Yeah, cutting through the noise.
Exactly. Getting to the heart of what it means, especially for investors.
Okay, so ARES Management, they definitely put up some strong numbers for Q1 2025.
Seems like it. What stood out?
Well, you saw pretty significant year-over-year growth, basically, across the board. Management fees were up 18%.
Okay.
Their fee-related earnings, FRE, that jumped 22%.
Nice.
And the after-tax realized income per share, that was up 36%. Pretty impressive.
That is impressive. And they mentioned fundraising and deployment too.
Yeah, record first quarter fundraising, actually. And they put a lot of capital to work as well.
And that big headline number, AUM.
Right, assets under management.
Yeah.
They cracked $500 billion. Came in at $546 billion. Now, that does include the assets from the GCP International deal they did.
Got it. That acquisition boosting the numbers there.
Definitely. Oh, and they also announced a pretty hefty dividend increase, 20%.
20%. Okay, shareholders will like that.
For sure.
All right, so let's unpack this a bit. Management talked about, market volatility, uncertainty, yet they still pulled off this kind of growth.
Yeah.
How did they navigate that environment?
Well, several things, really. That management fee growth. Part of it's the core business doing well.
Yeah.
But yeah, the GCP addition certainly helped.
Oh.
And the fundraising, like I said, was really strong. Over $20 billion in gross new capital.
Just in Q1.
Just in Q1. Across lots of different strategies, too. Shows investors are still confident, right?
Seems that way.
And deployment was solid, too. Over $31 billion. So, yeah, AUM and fee-paying AUM up 27% and 25% year over year. The trajectory looks good.
Now, there was some talk, wasn't there, about maybe more M&A activity kicking off because of new administration policies?
Yeah, initially. There was maybe some optimism there.
And then tariffs happened.
Right. And that seemed to inject a dose of volatility back into the market. We heard that things slowed down a bit in the liquid credit and equity markets. Investors got a little more cautious.
Yeah.
But interestingly, that kind of environment, it actually makes the stability of private markets look, well, more valuable.
Ah, so it plays to their strengths.
Exactly. And ARES is sitting on a ton of dry powder. What was it? $142 billion.
That's a lot.
Yeah. So they're pretty well set up to jump on opportunities if markets get dislocated.
Mm-hmm.
Provide capital when maybe others pull back.
And they talked about their business model being resilient, didn't they? Something about management fees, low leverage.
Precisely. That management fee focus means their income isn't solely tied to their own investment performance. It's more stable, linked to AUM size.
Right.
Low balance sheet leverage helps reduce risk. And that capital they manage, it's mostly long-term, locked up.
So they don't get forced sellers in a downturn.
Exactly. They're not under pressure like that. And they also mentioned being overweight senior credit assets. That's generally seen as more defensive, higher up the food chain if things go wrong with a borrower.
Okay, let's talk about that fundraising success. You said it was broad.
Yeah, really broad. What caught my eye was that over 45% of the Q1 haul came from outside their traditional credit group.
Oh, interesting. So where?
Real estate, infrastructure, debt, secondaries, even private equity.
So diversification beyond just credit.
Definitely. It suggests investors are looking for different kinds of alternative exposure, maybe uncorrelated returns,
Yeah.
And it positions ARES well for different market cycles, doesn't it? They aren't just a one-trick pony.
Any specific funds that did well?
Yeah, they mentioned their third opportunistic credit fund, their BDCs, both public and private, a European direct lending product, also real estate funds, infrastructure, secondaries. It was pretty widespread.
And who's putting the money in? Still mostly institutions?
Yeah, institutional investors were a big part of it.
Yeah.
And interestingly, a high percentage were repeat investors.
That says something about their track record, I guess.
It certainly does.
Yeah.
It shows those relationships are strong.
And it wasn't just the big institutions, right? The private wealth channel came up too.
Oh, absolutely.
Yeah.
That continues to be a really strong growth area for them. They hit record quarterly equity commitments there.
Okay.
And total commitments across their perpetual semi-liquid products were also at a record.
Semi-liquid, meaning easier access for wealthier individuals compared to traditional lockups.
Kind of. More flexibility, yeah. And they said inflows were still looking strong in April, so that momentum seems to be continuing.
Makes sense. Diversification is key for everyone these days.
It really is.
Yeah.
And alternatives offer that potential. away from just stocks and bonds.
So looking forward then, what about deploying all this capital? Is the pipeline still looking good despite the market jitters?
Yeah, they said the firm-wide pipeline is holding up relatively well, which is interesting given the uncertainty. And some areas, like opportunistic credit, alternative credit, secondaries, they actually expect more deal flow now.
Because volatility creates opportunities.
You got it. In direct lending, they're seeing bigger companies looking for financing. And real assets, especially things like data centers, power generation, still lots going on there.
So they see this volatility as an opportunity, not just a risk.
Seems that way, yeah. They're poised to act.
What about the GCP International integration? How's that going?
Sounds like it's progressing well. They mentioned some encouraging early fundraising momentum in that part of the business.
Good sign.
And they expect synergies to kick in over time. You already saw a bit of the impact with their other fees revenue line.
How so?
Well, other fees nearly doubled. And a big chunk of that was development fees coming from those GCP funds. So that's an immediate benefit of the acquisition showing up.
Right. Okay, let's drill down on the financials a bit more. Record management fees, you said $818 million.
Yep, driven mainly by that AUM growth.
And the jump in other fees, mostly GCT.
Mostly the development fees from GCP, yeah. Enhanced their real estate side. Fee-related performance revenues were decent too.
So all that led to the 22% jump in FRE.
Exactly. Fee-related earnings hit $367 million. It just reflects the bigger scale and solid performance of their fee-generating businesses.
Did they talk about margins? Sometimes acquisitions can dilute margins initially.
They did. They acknowledged the GCP deal had a modest initial drag on SRD margins.
Okay.
But they expect synergies and also better operating margins in some areas, like their data centers, to offset that going forward.
And what about the actual performance of their investments? How did the portfolios hold up?
It looked pretty solid. They reported positive returns across their credit strategy composites.
Good.
And importantly, both the U.S. and European direct lending portfolios, showing strong credit quality. The companies they lend to are growing EBITDA year over year. Loan to values look low.
And defaults, non-accruals.
Still low. Non-accruals remain at low levels, they said. Even in real estate, they're seeing property values improving.
So overall, pretty healthy underlying performance.
Use that way, yeah.
And that FRE margin outlook.
Yeah.
They're sticking with that 0 to 150 basis points expansion target.
Yes, they reaffirmed that. They still think it's achievable.
Despite the GCP drag.
Despite the temporary drag.
Yeah.
They're banking on those synergies and operational improvements kicking in. They also mentioned, they're still investing in the platform, hiring people, which might have a short-term impact, but is necessary for long-term growth.
Right. Got to invest to grow.
Exactly.
It's interesting they see more deployment opportunities when M&A slows. Where does that capital go instead?
Well, that's when areas like opportunistic credit really shine. Also, secondaries, alternative credit strategies, especially asset-backed finance.
Okay.
And even their main strategies, they have flexibility to pivot towards more opportunistic deals when the market shifts like that. That platform breadth is a real advantage.
Makes sense. And Europe came up specifically as an area of opportunity.
It did. They're seeing more investor appetite for Europe.
Why is that?
Well, the European private credit market is generally more fragmented than the U.S.
So less competition, maybe? Or different kinds of competition?
Kind of. It gives a big player like ARES with established teams and relationships potential edge. And they're seeing deployment pick up in their European direct lending strategies already.
Interesting. And the secondaries market, you mentioned that too. Sounds like it's changing.
Yeah, it's really evolving. It used to be mostly about buying stakes in old private equity funds.
Right. LP-led secondaries.
Exactly. Now you're seeing it expand much more into real estate, infrastructure, credit secondaries. And there's a better balance now between those LP-led deals, people needing liquidity, and GP-led deals, where the fund managers themselves are restructuring things.
And what's driving that? Just the need for liquidity.
That's a big part of it. Liquidity constraints are pushing institutions, even university endowments, they mentioned, to look at the secondaries market more actively. It's becoming a more mature, dynamic market overall. Got it. Okay, last couple of points. Direct lending spreads. Did they widen out much with the volatility?
They did widen out for a bit, when uncertainty spiked, but they've apparently normalized somewhat since then.
Still attractive, though.
They said spreads remain attractive relative to the return opportunity, And crucially, investor demand for private credit just keeps going strong.
Across the board.
Pretty much. Across geographies, different strategies, big allocations coming from public institutions, but also wealth platforms really leaning in.
And why is private credit so popular?
Performance, really. Its performance relative to other asset classes, especially in uncertain times, has been a key driver. Plus, you mentioned asset-based finance. They see huge opportunities there, too.
Why asset-based?
Changes in bank regulations, shifts in capital markets are creating gaps that firms like ARES can fill. But you need scale, experienced teams, bank relationships to really play there effectively.
Right, not something just anyone can jump into.
Not at scale, no.
Okay, that's a really thorough breakdown of the call. Thanks for that.
Sure thing. Now, let's pivot to our favorite speculative segment. This is not financial advice.
Definitely not. Purely hypothetical brainstorming here.
Absolutely. But based on everything we just discussed, let's toss out some outrageous but plausible trade ideas. You go first.
Okay, all right. Well, thinking about that increased focus on Europe, right? And ARES' position there in direct lending.
Yeah.
How about this? Maybe you consider going long a European-focused ETF that specifically tracks private credit. The idea being you're betting on more capital flowing into that space in Europe.
Okay, so a long on European private credit.
Yeah. And maybe, just maybe, to hedge it a bit against wider market swings, you could pair that with a short position on a U.S. high-yield bond ETF.
The thinking being?
The thinking being that maybe traditional U.S. high-yield underperforms relative to European private credit if volatility picks up again. It's a relative value play, sort of. But again, just an idea, not advice.
Got it. Outrageous but plausible. I like it. Okay, my turn.
All right.
I'm looking at that $142 billion in dry powder ARES has.
Yeah, it's a war chest.
And their focus on opportunistic credit when markets get choppy. So
Yeah.
what if? What if you took a leveraged long position in ARES management stock itself?
Ooh, bold. So betting directly on them, deploying that capital well.
Exactly. Betting they can really generate strong returns from dislocations. But it's leveraged, so high risk, high reward, right?
For sure. How do you hedge that?
Well, to protect against just the whole market tanking and dragging ARES down with it, maybe you buy some cheap out-of-the-money put options on a broad market index, like the S&P 500, kind of like portfolio insurance.
Okay. So long leveraged ARES hedged with broad market puts.
Yeah. Again, purely hypothetical. It's super risky. Definitely not financial advice.
Understood. Those are definitely some interesting thought experiments.
That wraps up our deep dive into the ARES Management first quarter 2025 earnings call.
We covered the results, the strategy.
And threw out some wild ideas at the end there. Please remember, nothing we talked about today constitutes financial advice.
Always do your own homework, your own due diligence.
Absolutely. Before making any investment decisions. But we'd love to hear what you think. What are your thoughts on ARES strategy, the opportunities in private markets?
Yeah, join the conversation online. Let us know.